In this video I walk you through how to use the basic startup financial model from startupfinancialmodels.com. We have three tabs in this Excel spreadsheet here. The first one, the About tab, is just an overview of what this financial model is about and the way to get in touch with me. To start off with the projections, we go over to the dashboard, and here what we do is we fill out the gray cells here, which I've already done for this example. We see on top there's 4 graphs where we can look at how does our cash balance evolve over time over the whole 5-year period, over the first 12 months, over the first 6 months. We can look at what the cash flow looks like. So in order to do this, for this example, we assume we are a company that produces a specific smartphone product, high-priced one. It costs 1,000 euros or US dollars or whatever you want per unit as a sale price. So that's what we put in here. You can put in up to 10 products. Actually, we only have one for this example. Now, besides the revenue we also have cost of goods sold, which are the costs to produce the smartphone. So it's material cost, it's the compensation of workers who produce it and for manufacturing, and that's what we put in here. And then to the right, we see we can put in the units sold on a monthly basis for the first 6 months, then on a quarterly and eventually on a yearly basis. And we just put in how many units we sell of this product or we expect to sell. Now further down we have our staff assumptions. We factor in there's a CEO and founder who makes 50,000 a year. We don't have to pay payroll expenses for him. It's just an assumption we make here. And there's 1 the whole time, so for each month, quarter, a year you put in 1. And then there's an assistant that we hire in month 4, so there's nothing for the first 3 months, but then we hire 1 and keep him on. And he makes 20,000 a year, and we have to pay 20% overall on top of the gross salary for payroll expenses. Now there's another section where we can put in expenses. There's a lot of space to put in detailed expenses. You can put them in on a fixed basis per year. So every year we say there's a marketing budget of 10,000, and also we can put it in as a variable expense in addition to that in terms of the revenue. So let's say for marketing and selling we expect to always spend 10,000 a year, but then we also spend 20% of the revenue each year. Same here, general administrative, where we have, for example, bookkeepers that are gonna be more expensive the more revenue we have, but we say at least we have to pay 15,000 for all of that, secretaries, office, buildings, but 10% we also pay of the revenue we make. Research and development, same kind of stuff we put this in. And then we also have one-time expenses, for example, for legal fees and consulting. Let's say we want to file a patent or whatever, and we need a consultation which costs 5,000 in month 5. And we've seen up here that from month 4 to 5 we actually have a huge jump from 100 to 500. We have this here from 20 to 102, but here we can say, yeah, maybe this is just word of mouth or just us working a lot in it. But here to scale it up, we have to invest some money, and we spend 10,000 in a marketing campaign to make this happen. So that's why we put this in as a one-time expense, because it's actually just in this month that we have to do this. And then there's capital expenditures like a laptop, and as you can always see, you can always change this in the gray area. You shouldn't change anything else, only the gray fields. So when we say the laptop costs 1,000 euros, and we buy it in month 1, and then we say the founder has like 50,000 of his own funds in the beginning as a cash balance for the company. And then we go over to outside investments like equity investors, like angel investors or bank loans. And here we see we've put in 50,000 as an angel investment in month 2 that we repay at the end of year 1 at 4 times the initial investment money. And so the reason why we do this is we see when we delete this, we actually see in month 4 we're not profitable, and we're not even not profitable in the first 4 months. We're actually running out of money because in month 4 we had a negative 13,700 in the bank. So we don't want to do this. We don't want to run out of money. Let's say we can't afford to go that deep because we only have a credit line of 5,000. So we need to do something here. And let's say we convince an investor to invest 50,000. That's what we did, and he's gonna get back 200,000 at the end of year 1. And then we see we're not running out of cash, and the company can grow, and we can still repay him 4 times what he has invested and still create a very profitable business. And we can look at the cash flow here on top. Now there's a detailed cash flow tab that you can look at. You can see each month what the inflow of cash from revenues and investments and the outflow from costs and expenses is in detail, and how the cash balance changes. If you want to look at that, you can also just look at the graphs here to get an overview if your business idea is viable.